Well, the budget has been done and digested, and some would argue that markets today would be reacting to the nuances and really the fine print. And when it comes to combing the fine print, the full stops and the commas and the exclamation marks, well, nobody does it better than Ridham Desai, Head of Equity Research with Morgan Stanley. Ridham, you've been tracking budgets for over 25 years. What is different about this budget in terms of messaging, in terms of setting the tone? Because your research report in the morning, which has hit our mailbox, is indicating that the budget addresses the near-term growth challenges. Before you comment on this budget, what do you like about the design of the budget and what is that you don't like about the design of the budget?
So Nikunj, I think I'm very happy with the budget. There were three big things that we were looking for. The first was taking opportunity of the low-hanging fruit on the external side. Given the trade war between US and China, we were sensing that there was a lot of interest in investing in India. The government has attacked that head-on, not only in equities but even in bonds. So you have the government taking a courageous step of proposing a sovereign bond, opening up of FDI limits, and even more interestingly, opening up of FPI limits. And that was long overdue because in the last 5 years, we've had a secular fall in FPI flows versus FDI flows. So that, I think, is one thing that we liked about the budget. The second thing that we were expecting was that the government will address the shortage of capital with the public sector banks. So they have put in 70,000 crores of capital. We were hoping the number will be somewhere between 70,000 crores and 1 lakh crores. So it's at the lower end of our expected range, but nevertheless, that capital is coming. Mind you, the public sector banks have a low loan to deposit ratio. So they have the liquidity to lend, but they didn't have the capital. So this will clearly fuel credit growth. And simultaneously, the government did something that I was not expecting, which is also provide a liquidity window for the NBFCs. So now we have the RBI that has opened a 1,34,000 crore liquidity window where the banks can borrow and lend onwards to the NBFCs, and the government is backstopping the equity loss. So that was a positive surprise from where our expectations were. And the third thing, we were hoping and expecting that the government will keep the fiscal deficit in around 3.4%. There was a slight positive surprise there. The deficit is going to be at 3.3. The numbers look credible. So I think this 3.3 will be achievable. And that is, I think, good because it will allow the RBI to continue to focus on lifting the monetary burden that has been there on the economy. So continue to ease. So I think this is a good budget from addressing the immediate growth prospects that the economy had. And therefore, I think we should be quite optimistic about growth going forward.
Ridham, the budget also has now set a precedence for shareholding or promoter shareholding, which will come down from 75% to 65%. So in next 2 to 3 years or 3 to 4 years, we are looking at a lot of equity issuance coming to the market. Now MSCI watchers would say free float, great news, but a purist would say that is more supply, which will just choke up a lot of flows.
So Nikunj, see, this is not yet announced. The government has asked SEBI to look at this proposal. So firstly that. So it's not like it has been decided that public shareholding will be at 65%. Second is that this is a very complicated issue. The supply angle is actually the least of my concerns. I'm most concerned about prospective listings where new companies coming to the stock market will hesitate because they have to dilute a third of their equity upfront. Companies historically have not gone and listed in that fashion. Companies choose to dilute a little bit, let the secondary market discover a fair price, and then come and raise more capital. They also tend to dilute a lot less in the beginning because you don't need all that capital upfront. I mean, if you're a largish company, it will create a massive amount of capital and therefore dilution in return on capital if you have to raise so much money in the company's balance sheet. And even promoters may not want to sell down so much. So I think it does create a problem for new listings, and that has to be examined carefully. The other problem is with respect to multinational subsidiaries in India, which prefer to be at 75% because that's the threshold for special resolutions. And if they are now forced to reduce to 65%, they might as well, delist their companies, which takes away a pretty large investable universe for investors in India. So the issues go beyond just the supply. We actually did a rough calculation for the BSE 200 companies. If all of them had to go to 65%, then the supply would add up to around $30–35 billion. And suppose they're given 3 years to do this, it's not actually going to be such a big problem for the market to absorb that much of supply, especially if it's a bull market. Mind you, in 2010, the government had mandated the minimum public shareholding to 25%, and it wasn't as disruptive as a lot of people thought at that time. So I think this is a complex issue. It requires a thorough examination, and I'm sure SEBI will look at this in consultation with market participants, in consultation with experts, and come up with this decision. So it's not cast in stone that we're going to get this increase. Let's see how the regulators work on this and what final proposals come to the table. I think it will take 3 to 6 months for us to actually know what happens. On the free float thing, you're absolutely right. It's very positive for free float. But actually the bigger positive for free float was the subsuming of FPI and FDI limits. So, just as a background here, in 1993, when India first allowed foreign investors to come to India, they had set a minimum FPI limit of 24%. Then companies could raise this in consultation with the board, who could then go to the shareholders and raise that limit. So it was the prerogative of the board of directors to raise that limit. A lot of companies chose not to do it because they did not want foreign investors in their company, afraid of losing their controlling stakes because they did not have enough stock themselves. Now what has happened is that the finance minister has said that FPI limit is automatically the FDI limit. Now in most sectors the FDI limit is at 100%. Therefore the FPI limit is also at 100%. And as a company, if I choose to have a limit which is lower than this, I have to go to my shareholders proposing a lower limit. Now that's a whole lot harder, because imagine you go to the shareholders and say, I don't want foreign investors, I don't want my share price to go up, and therefore let's have a lower foreign limit. It's not a resolution that gets passed so easily. So I think that was a much more important announcement with respect to free float than the proposal for 25 to 35, which I think is still a proposal. It's not actually done.
Enough, and that will have to be looked at fairly closely. You brought out some valid points, but I'm curious to understand your take as well with respect to disinvestment. With what has been doled out in this budget, given the fact that we've seen how the government has gone ahead with stake sales previously, do you think that it is actually going to be smooth sailing for the divestment process going forward?
It hasn't been over the past several years. With the previous government as well as the government before that, and we formed a kind of a habit to meet the targets by transferring resources from one PSU to another PSU. So I'm really hoping that there is more attention paid to this. I heard the word strategic for the first time in many years in the budget speech. So I hope that is looked at more carefully, and where PSUs really don't need to operate, I think strategic sales are in order. So hopefully there is some change to the approach to divestments. For now, I'm not making that as my base case. I still think it will be what we have seen over the past few years, which is that the government will come to the capital markets and sell stakes largely to their own institutions, and then when there's a gap, they'll engineer some transfers of resources from one PSU to another PSU. In the same vein, actually, there's one interesting comment that came in the budget, which is that now government holding in PSUs will be measured by totaling the holding of the President of India and the holding of government-owned institutions, which therefore means that the government is actually now prepared to go below 51% in many cases, because the President of India was holding 51% as the mark of government ownership in PSUs, and institutional ownership in PSUs was not considered as holding. This also has free float implications, because in large part LIC's holdings in Indian companies is considered as government holding by MSCI and is not considered as free float. And if that is now changed as proposed by the budget, I think you see more free float for India. So this is very bullish for foreign flows into India, especially for passive flows, because India's free float goes up, and therefore India's weight in the MSCI index goes up. But that's a separate issue. On divestments, I'm a little less constructive. I'm hoping that there is change. Let's see if that happens. But the word strategic at least came back.
Ridham, I just want to address something. there were hopes that the budget would tackle the consumption slowdown, provide some incentive for exports, of course, and address the entire liquidity issue. Now, do you actually think that what they've done with regards to trying to ease liquidity will be enough to really start lending activity again? And B, more importantly, perhaps, in terms of the tonality of the budget, and given what we've seen on the taxation front, do you really feel that there is enough incentive, perhaps, for people who are likely to take risk with their capital?
So see, on the liquidity issue, I think this was as much as anybody could have done. Anything more would have been a moral hazard, because it would have been then tantamount to bailing out a few NBFCs. And I don't think that would have been a good precedent to set. Actually, the government has avoided that over the last 5 years, and I think that's a good practice, is to individually go and bail out companies that are in trouble. I think we have to end that scheme in India. I think businesses take a risk. Sometimes they fail, and we should let them fail. If they present a systemic problem, then the government needs to step in. And I think, therefore, this liquidity approach that the government has come out is, I think, the appropriate one. Without actually bailing out any single entity in the system, you have basically put a floor to the systemic problem that the NBFC problem could have created. So that's on liquidity. With respect to growth, I think the budget has actually done a lot, because it now allows the RBI to get even more accommodative. My own diagnosis of the growth problem was that it was a monetary phenomena, that we were running very tight monetary systems, and that, I think, has eased over the past 4-5 months. Given that this government is planning to keep the deficit under control, I think the RBI will have greater room. Again, given that they are going abroad to raise capital, again, actually is good for growth in India. So I think it does fix, in large part, the cyclical growth problem that we were facing, as much as it could within the constraints of India's fiscal deficit. And the third issue you raise, I think you are alluding to the tax on the super rich. So I'm a bit philosophical about it. I think 50,000-60,000 people are likely affected by this. And I think they should consider this as their contribution to nation building. In the context of what resources the government has, I think if they are contributing 12,000 crores, I don't think it should be a problem. Again, philosophically, I think these 50,000-60,000 people voted for a majority government, so I think they trust this government will spend their tax resources well. And then again, this is a surcharge, and I know a lot of surcharges have not come off, but I'm hoping and expecting that this surcharge will go away when tax revenues improve, if growth improves. So, and the biggest beneficiary of any growth improvement are precisely these 50,000-60,000 people. So I'm not so perturbed about the super rich tax, if that is what you were pointing out to. And I don't think they are going to actually upset the capital allocation process either. Because remember, the government is now inviting a whole slew of foreign investors to come in. So there is enough capital that can be applied into the economy.
Stay on that point. It's not about taxing super rich. I mean, if I just look at the general thought, some would argue that the entrepreneur, why should an entrepreneur take risk? Because if you go wrong with your business investment, you have to deal with IBC and NCLT. If you are able to get a business cycle right, or your business right in a market like India, which is extremely competitive market, where interest rates are high, where land reforms and labor reforms are not the best in the world, then I would be taxed higher. So purely in terms of the spirit, purely in terms of a notification, purely in terms of a thought process, it may not be a great feeling to have.
No, but Nikuj, they have not taxed corporate entities higher. I mean, if anything, corporate entities are experiencing lower tax, right? So corporate tax is constant at 30% and is down to 25% now for revenues up to 400 crores. So businesses have not been taxed at all. I mean, these are specific individuals, which is not the same as taxing entrepreneurs and businesses. And if anything, actually, the budget is very gung-ho about pushing investments and entrepreneurship. So it is going out of its way to support micro and small enterprises. It has gone out of its way to keep the fiscal deficit intact and therefore allow for lower interest rates. It's taking a big risk in going abroad with a sovereign bond issue, which means lower supply of bonds in India. That means lower interest rates. It's opening its doors to foreign capital, which is what exactly entrepreneurs in India need. So where is this budget anti-business? I don't think it is anti-business. That would be a wrong characterization of the super rich tax. I can understand that there will be a few people, and a lot of them come on your TV channel, so we get a feeling that, oh my God, this is a really bad thing. And I know it doesn't feel good if you have to pay 5 or 7% higher tax. But you know, as I said, this is a surcharge, and it comes in the context of the struggle that the government has with respect to revenues, because growth is not so good. And where do you get it? So let's not forget, the government has also taxed petrol and diesel, which is used by everybody in the country, and everybody is going to pay more for petrol and diesel. So it's not, it's not so straightforward to raise revenues to balance the deficit in an environment where growth is a problem. When growth comes back, as I said, I hope and predict that this surcharge will come off and we'll be all okay. And when growth comes back, these super rich people are the most biggest beneficiaries. So they want the growth as much as anyone else. In fact, they want it more than anyone else.
Just to summarize our today's interaction, when we met before the budget on the sidelines of the Morgan Stanley conference, your view was that a second half recovery cannot be ruled out. The economy got hit because of liquidity concerns, and if liquidity comes back, automatic lending will start. Looks like the budget has given you exactly what you wanted when we spoke at the sidelines of Morgan Stanley conference, which is acknowledging that there is a liquidity crunch, giving avenue to finance that crunch, and then, like you said, that opening up a big door of growth capital from overseas market to take things forward.
Yeah, I think so, Nikunj, with only one caveat here, that the global environment has looked increasingly tepid. So even though less than a month has passed since we met on the sidelines of our investors summit, global growth looks less assured. So we are now operating in an environment where we will struggle to grow our exports. We were pitching for using the current environment globally to improve India's share of global exports as well as global capital flows, and I think the government has done its bit in the budget. But on an absolute basis, global growth does look challenged. In fact, overnight we have gone underweight global equities. We think global equities as an asset class will underperform other asset classes, and this is largely to do with our view that growth is slowing down. So just keep that in mind. I think India's own cycle will be turning, but the absolute number has to be kept in context of what the world is doing. India is not a small economy anymore. It's in the top 6 economies in the world, so it's large enough to be affected by global factors. A little less so than, say, China or Korea or the US, but nevertheless cannot be totally unaffected.
Closing comments really, and I'm just tempted to have one more follow-up question. We are interacting after a month, but I know that the next interaction would be after a gap of more than a month, so I don't want to let this chance go. The bond market on Friday told you a different story. The rupee market was stable. Is that the more mature way of looking at things? Because equity market in the short term will be sentiment. Bond market is where you would imagine that there would be some maturity. And is the bond market really capturing what the budget was all about?
But Nikunj, the budget is very bullish for bonds. So think about all the things that the bond market got from this budget. Actually, I would say a little bit more than the equity market. The bond market got a fiscal deficit that was lower. That wasn't in the base case. I think most bond market participants were expecting a slightly higher deficit. So they were expecting higher government paper in the markets. Then the government said, we're going to take part of our supply and raise it overseas. So actually, government paper supply is going to fall year on year. That hasn't happened in a while. So this is pretty bullish for bonds, right? And because the deficit is lower, it allows the RBI to cut at the short end, which is, I think, something that we should now expect, and maybe 2 more rate cuts before the year is done, which again is bullish for bonds. So this is a pretty good budget for bonds. Eventually, I think bonds will get overvalued relative to equities, and equities, on a relative basis, will become more juicy compared to bonds. But yeah, it's quite bullish for bonds. So I don't know about the mature reaction, but it's certainly the right reaction, because the budget has marked yields lower and is arguing that bond yields need to fall even further, which again should be good for growth eventually. So it's good for growth, and therefore equity markets will eventually respond.
joining us this morning. Always a pleasure and good to get your thoughts on Budget 2019. Look forward to chatting again soon.
Thank you.